In a bold move that has sent shockwaves through the global energy market, Canada has orchestrated a dramatic shift in its oil trade strategy, bypassing its long-standing reliance on the United States and forging a direct path to China. This strategic pivot, made possible by the completion of the Trans Mountain Pipeline expansion in May 2024, has not only reshaped Canada's economic landscape, but also ignited a fierce competition in the electric vehicle (EV) sector. The Trans Mountain Pipeline, a $34 billion investment that more than tripled its capacity to 890,000 barrels per day, has become the cornerstone of Canada's new energy export strategy. Since its completion, a steady stream of oil tankers has been passing under Vancouver's Lions Gate Bridge, laden with Canadian crude bound for Asian markets, particularly China. This shift marks a significant departure from Canada's historical dependence on the U.S. as its primary oil customer, a relationship that had often left Ottawa with limited control over pricing and subject to the whims of Washington's trade policies. The impact of this realignment has been swift and substantial. In the first 11 months of 2024, Alberta's energy product exports to China skyrocketed to $2.0 billion, a five-fold increase compared to the same period in 2023. This surge is entirely attributed to crude oil exports, which went from $0 to $8 billion in just 1 year. The newfound ability to ship directly to Asian markets has not only diversified Canada's export portfolio, but also helped narrow the light-heavy oil price differential, a long-standing issue for Canadian producers. China, eager to secure stable energy sources and reduce its reliance on sanctioned countries like Iran and Russia, has emerged as a voracious buyer of Canadian crude. The largest single purchaser is Rongsheng Petrochemical, a Chinese firm operating expansive refineries on China's east coast, including an 800,000 BPD facility in Zhejiang province. This alignment of interests between Canadian supply and Chinese demand points to a trading arrangement that could potentially weather future ups and downs in the bilateral relationship. However, this strategic shift has not been without its challenges. The U.S., caught off guard by Canada's bold move, has found itself scrambling to adapt to the new reality. American refineries, long accustomed to a steady supply of discounted Canadian heavy crude, are now facing higher production costs and the need to seek alternative sources. This disruption has led to the imposition of tariffs and a reconsideration of long-standing trade policies, exposing vulnerabilities in U.S. energy security. As if to underscore the changing dynamics, Canada has also taken aggressive steps in the electric vehicle sector, mirroring actions by the U.S. and the European Union. In a move that sent ripples through the automotive industry, Ottawa announced a 100% tariff on Chinese EVs, effective October 1, 2024. This decision, coupled with a 25% levy on Chinese steel and aluminum, represents a stark departure from Canada's traditionally cautious approach to international trade. The EV tariffs are part of a broader strategy to protect Canada's burgeoning electric vehicle industry and its workers from what Prime Minister Justin Trudeau described as China's intentional state-directed policy of overcapacity. With auto manufacturing directly supporting over 125,000 good-paying Canadian jobs and the country's EV supply chain potential ranked first in the world, the stakes are high. These protectionist measures, however, have not come without controversy. Critics argue that the tariffs will raise EV costs, reduce consumer choice, and potentially hinder the widespread adoption of electric vehicles, despite government rebates. The move has also complicated Canada-China relations, with Beijing likely to respond with retaliatory measures. The geopolitical implications of Canada's dual strategy, redirecting oil exports to China, while simultaneously imposing tariffs on Chinese EVs, are profound. It positions Canada as a more independent player on the global stage, capable of making bold economic decisions that challenge the status quo. This newfound assertiveness has not gone unnoticed in Washington, where concerns about losing leverage over its northern neighbor are growing. As these seismic shifts unfold, the global automotive industry finds itself caught in the crossfire. The threat of U.S. tariffs on Canadian and Mexican imports looms large, with potential to disrupt the deeply integrated North American auto supply chains. Industry analysts warn that if a 25% tariff were imposed on Canadian auto exports to the U.S., it could lead to cost increases of $5 billion or more annually for major producers like Toyota, which manufactures over 500,000 vehicles per year in Canada. The ripple effects of these trade tensions are already being felt. Even without the imposition of tariffs, the mere threat has cast a chill over non-U.S. automotive investment in Canada. The long-held assumption of integrated North American automotive supply chains has been shaken, potentially nudging future investments towards the U.S. As Canada navigates these turbulent waters, balancing its newfound oil trade leverage with the challenges in the EV sector, the global energy and automotive landscapes are being reshaped. The country's strategic gambit, leveraging its vast oil resources to gain economic independence while simultaneously protecting its nascent EV industry, represents a high-stakes play in the evolving drama of international trade and energy politics. The coming months and years will be crucial in determining whether Canada's bold moves will pay off, securing its position as a key player in both the global oil market and the electric vehicle revolution. As the world watches, the reverberations of Canada's oil coup and EV gambit continue to echo across borders, challenging alliances and redefining the rules of engagement in the high-stakes game of international trade and energy dominance.